and welcome to the podcast from Union Bank of India. I am Gunasilan. We are back and very happy to reach out to you through this podcast. Today, we are going to dive into the most anticipated event in the financial calendar, the Union Budget 24-25, presented by Finance Minister Nirmala Sitharaman on her 7th consecutive budget speech. In this episode, we will break down the key highlights, decode the numbers, and explore the possible impact of the economy, resident individuals, and various sectors. To share our banking and economic team research views on the budget, we have an expert with us. It is my pleasure to introduce the Chief Economic Advisor of Union Bank of India, Ms. Kanika Pasricha. Ms. Kanika Pasricha is an economist with more than 16 years of experience. She is an MA Economics from Delhi School of Economics, Delhi University. She joined with Union Bank of India as a Chief Economic Advisor since Jan 2024. Ma'am, welcome to the podcast.
Thanks a lot, sir, for having me here.
Thank you, ma'am. Ma'am, what is your first quick takeaway from the Union Budget 24-25?
So actually, our compliments to the Finance Minister, because in our view, the three themes that she was dealing with, which is RevEx, where some streaks of populism were looking at, especially after a slimmer majority in elections. So revenue spending pickup. Second, reform measures, where she stays focused on the original goal of fiscal consolidation and capex, but yet focused on long-term vision as well.
Okay.
Last is rationalization, where it's for the first time that, or I would say after a very long time, that a budget has looked at rationalization of taxes across asset classes.
Oh, that's
So,
great.
What we actually thought is that this is a budget of 3 R's.
Okay.
RevEx, reform, rationalization, while the interim budget was a budget of 3 C's. Credible, capex, consolidation. So while some motives have shifted in the interim from Feb to July, but would still say she managed things very well in terms of not completely giving in to any populism, while remaining focused on macro stability, fiscal consolidation and capex over the medium term.
Okay, that's great, madam. Ma'am, the fiscal deficit number, as explained in our pre-budget podcast, came in line with our expectation as 4.9% of the GDP. Best compliment to you and the research team, ma'am.
Thank you so much.
But did the internals match? What is your view on that, ma'am?
So actually, see, the headline was same, where fiscal deficit was reduced from 5.1% of GDP in interim budget to 4.9%. So on an absolute basis, the fiscal deficit is down by around 60 to 70,000 crores. Now the revenue numbers, actually they came in line with expectations, where taxes were broadly kept unchanged, though there were a lot of internal movements within taxes. But overall, the tax buoyancy that we had mentioned last time,
Yes.
close to 1, they've maintained versus 1.4 last year. So the numbers appear credible, reasonable. On the non-tax side, as we had mentioned about degrees of freedom created by RBI dividend,
Correct.
that did come to fruition in the budget. So revenues were exactly similar, but when it comes to the spending mix, of course they stay focused on capital spending. But as we had mentioned in the pre-budget podcast as well, while we had thought that maybe some 30-40,000 crore more allocation would come to states, would come for capex, within which loans to states will go up, but the major part of rise in spending after adjusting for fiscal consolidation went for revenue spending. Hence the first stream RevEx.
Okay, ma'am. Madam, after the budget, rupee slipped to record low, while benchmark bond yields are really unchanged. How do you see the market outlook post-budget?
So, that's another area where we differed from the finance minister. We thought that they will reduce the fiscal deficit in absolute terms by 70,000 crores to 4.9%, and we were one of the few in the market calling for it. But we thought that the fiscal consolidation undertaken would be adjusted by a lower dated security borrowings. But the finance minister probably thought that there's already demand for dated G-Secs. There has been bond index inclusion this year. So she adjusted the entire amount via drop in T-bill borrowings by 50,000 crores.
So dropped in T-bill borrowings.
Absolutely. And on a YOY basis, the drop is more than 1 lakh crores.
So more than lakh crores. Okay.
Absolutely. So what they have done is that A, Of course, dated G-Secs have gone down, but only by around 15 to 20,000 crores, very, very minimal, which is why the bond markets, the 10-year bonds did not respond as much. But the shorter end of the curve, we think, now will have some more meat to look at for 2 to 3 reasons. First is, of course, the supply pressures come down. There's a net redemption of 50,000 crores. Second, and very important, is that the government for the first time wants to draw down its cash balance by 1.4 lakh crores. Last year they built it by 1.72. This time they want to draw it down, which means a liquidity kicker. Because last year was a period when government balance being elevated had kept liquidity pressures on the system. So that issue was sorted out. The government wants to spend out of its cash balance. That will lead to surplus liquidity in the system. Again, supports the shorter end of the curve. So from a demand supply dynamics, while we think the longer end of the curve remains favorable, on a shorter end basis, the budget has, created a conducive environment of favorable conditions. Coming to rupee, actually, see, rupee is having its own dynamics as well, because while dollar has been on a weak footing, but overall dollar remains supported in a regime where markets are contemplating whether Trump is coming back in the November elections or not.
That is a great expectation from the market.
Absolutely. We were looking at a lot of discussions happening that while Trump wants a weak dollar, whether he'll be able to manage a dollar depreciation. Because Trump means trade wars means risk aversion, and means dollar strength.
The entire world knows that chain of the events.
And anyways, overall still conditions for rupee remain favorable in the very short term with the September rate cut by the Fed. There's a 100% probability, some salutary effect there. Flows from bond index inclusion continue, and oil prices coming down back to $80-81 threshold is another positive. So overall, rupee still remains in a range, and that tight range may continue. But from a bond market perspective, favorable conditions created by the budget.
Ma'am, what is the impact of this budget to the banking sector?
So a lot of measures in the financial sector. See, what happened is that, before the budget, we were contemplating that today capital markets in India are buoyant. In fact, across 3 asset classes where you see real estate, gold, equity, the returns are way above mean. Now, issue is that financial savings of households, or I would say the overall household savings, they're not moving into bank deposits, but they're favoring more of real estate, gold and equity. In fact, the share of physical savings in overall household savings is back to 70%, way back seen in taper tantrum. Now, in a period where we are in a high growth phase, credit growth is more than deposit growth, and if banks don't get deposits via households, but they get channeled back via mutual funds or corporates, that's actually leading to a structural slowdown in CASA. It's leading to financial instability issues, elevated CD ratios. That has been managed beautifully in this budget via tax rationalization in our view. Where they've looked at capital gains taxes that's been hiked on equity. So that's actually showing up in the equity market reaction as well.
segment also they hikes.
Absolutely. In fact, there was so much flow going there. The markets regulator SEBI had already started to take measures. Now the government has only pumped up the momentum in that regard, and that's a positive in our view. Compliments to them. So from a banking sector standpoint, the tax rationalization likely to help at least create some more attraction for deposits as an asset class for households, and help limit to some extent the financial instability currently. The one gold, they have reduced duty from 15% to 6%, but overall the framework is positive. That's one. Second, from a banking sector standpoint, the liquidity surplus that can come in from government drawing down its cash balance by 1.4 lakh crores, another positive salutary effect on deposit growth. The treasuries also can benefit from long bond positions. Third and most important is they also come up with measures like for MSMEs. They want to give a new credit guarantee scheme. They've hiked the Mudra loan limits. So the areas where a credit gap is persistent, they're trying to ensure more funding going from banking sector But yes, with proper credit assessment, because they want the banks to have their own internal credit assessment models
More
as well.
trust was given to MSME sector in this budget.
Oh yes, absolutely. The government is very well focused on manufacturing as a next growth driver as part of Viksit Bharat 2047 plan. That's one. And in this story, when they laid out their economic policy framework, they've also roped in financial sector strategy document.
Okay. Ma'am, during the pre-budget podcast, we have discussed about consumption boost and possible reduction in tax rate and standard deduction. I think as expected in our line. So as our team expected, there is an increase in standard deductions and slight modification in the tax slabs to boost the consumptions. How did the government address the issue to boost the consumption, madam?
So, I would say the government did some, but held back some as well when it comes to direct consumption impact. But they're more focused on medium term. And that's the beautiful aspect of the entire policy strategy. See, what did we call for in the pre-budget discussion? We were calling for standard deduction hike.
Yes.
We were saying 50,000 to 1 lakh. They've done 50,000 to 75,000. They've added additional deduction for pensions, family pensions as well.
Yes.
And that's likely to give, plus the tinkering of personal tax, income tax slabs for new tax regime.
Yes.
What the finance minister is claiming is that it will lead to 17,500 rupees income release for people who are part of the tax regime.
Yes.
That's a positive.
Yeah, up to 75,000 each taxpayers will get benefit.
Absolutely, absolutely.
So
17,500.
that amount will be in the hands of the each taxpayer for spending.
Absolutely. In fact, that's a positive, especially because when we discussed that last year, consumption growth was only 4%. So from just that standpoint, it's a positive. It's showing government's intent to support the areas of the economy that need a boost. But on the other hand, we had also talked about some transfers, maybe direct transfers via in rural areas or to farmers. That did not happen. Maybe the government is thinking the states are doing their job here. A lot of states have announced direct transfers to individuals via various schemes, and maybe they're relying more on the states to do that. But last but not the least, from a medium term perspective, the government has tried to focus on, and I would say after a very long time, on this whole issue of employment and skilling.
Yes.
In fact, they've come
It
up
is
with
one of the employment and skilling is one of the focused area in this budget.
it's the hallmark of this budget this time. Absolutely, where they have come up with close to 5 schemes.
5 schemes.
With 2 lakh crore investment over the next 5 years to support employment and skilling needs for close to 4 million youth.
4 million.
40 million, actually 4 crore youth.
4 crore youth. Okay.
In fact, they're also giving incentives. And, I'll give you an example, like first timer scheme. Then there's another scheme where they're asking top corporates to take interns, close to 1 crore interns.
And that is they're giving 12 months, every month also they're giving 5,000.
Absolutely, absolutely. So they come up with a lot of measures. While the amount taken out from this budget for this purpose is only 10,000 crores. But we want to see what is the implementation of these measures. But they can actually play a significant role in medium-term growth prospects, because consumption is the beacon of recovery in India.
Correct.
While we transition from consumption to capex as a growth driver, promising high growth, low inflation model, but underlying consumption is needed to even boost capex.
Correct. So when you say capex, I remember the infrastructure. Infrastructure as a sector, in last interim budget, we have seen the budget announcement of 11.11 lakh crores. This time the same has been continued. How do you see this, madam, from the focus on government's point of view?
See, I would say, if you still look at the numbers, while revenue spending in absolute terms, as we said, one of the themes was RevX, where they have hiked revenue spending by 65,000 crores compared to the interim budget, while compared to the interim budget, the allocation for capex has been kept unchanged. But compared to last year's budget, the growth in capex budget is around 16%, 16 to 17%.
Okay.
While that in revenue expenditure budget is only 4 to 5%. So there we think that focus remains on quality of spending. And look at the capex numbers. See, pre-COVID, capex spending as a percentage of GDP used to be around 1.7%.
Yes, correct.
Close to 1.6, 1.7%. They've already doubled it to 3.4%. So to say, the economy or the government, I would say, is reaching its absorptive capacity, because even this time they've kept some 65,000 crores unallocated capex for Department of Economic Affairs.
Okay, unallocated cap.
Yeah, so they're looking at schemes to implement capex spending.
Okay.
But the focus remains right.
Okay.
As the FM time and again said, fiscal consolidation with boost to capex. It is still a growth oriented budget. This budget, despite fiscal consolidation, is not hurting growth, because compared to the interim budget, they've actually hiked the overall spending numbers because of the fiscal bounty from RBI.
Correct. So the focus of government remains same for the infrastructure sector. How does the budget 24-25 align with the government's long-term vision for the country's development? Your views on that, ma'am?
So, in fact, before even answering this question, one of the points that we wanted to make is that in the run-up to this budget, there was a lot of discussion around what will the government do for the middle class to boost consumption. Will there be any populism? They already have degrees of freedom, where they have 1.3 lakh crore extra from the RBI, some more dividends coming in from PSUs, tax buoyancy, they're very conservative at only close to 1. So, and plus the cash balance of 1.72 lakh crores. So there was a lot of discussion that maybe there'll be streaks of populism, because coalition partners are coming out in the open, as the government has come up with slimmer majority this time. They manage the needs of coalition partners.
Okay.
But the beautiful aspect is the focus was on capex projects to be undertaken by these coalition partners.
Okay.
And the money also not coming from the budget, but from multilateral institutions.
They are arranging through the multilateral finance institutions.
Absolutely. So look at the beautiful way in which the focus is outlined so clearly. While you may think it's populist, but the focus is on capex, and that too not coming from the fisc. It's coming from multilaterals where the government is giving a guarantee maybe. So long-term vision for this government is very clear. It's a capex-led high growth, low inflation model, where they want a sustainable growth model. So they're focused on, as we talked about, financial stability, of course even macro stability, because fiscal consolidation is part of that framework, and they were also focused on debt sustainability. When you reduce your fiscal deficit in absolute terms, and your deficit as a percentage of GDP is going down, primary deficit adjusted for interest payments is going down, it's actually it bodes very well for a sustainable growth for the economy. Last but not the least, of course, the FM mentioned about, as part of the Viksit Bharat plan, at least for the next 5 years, they've laid out an economic policy framework where they want to look at the factors of production, land, labor, capital, how they can be facilitated for all-round growth.
Okay.
That actually shows that they're focused on manufacturing along with capex as a growth driver for the economy. In fact, even for the financial sector, they want to use the financial sector well to boost the momentum. They come up with a strategy. They want to come up with a strategy document. So, very balanced budget. And even when streaks of populism came out, the focus was mainly long-term and mainly led by capex. Plus consumption and employment, plus skilling.
That is, yes.
The hallmark of this budget, would say.
Okay, so Finance Minister has balanced the budget both the side.
Compliments to her.
Compliments to her. Yes, we will say compliments to her. Your final thoughts on the Union Budget 24-25, ma'am?
So I would say, as I mentioned, it is a very balanced budget,
Okay.
where they have restricted themselves to provide for any populist streaks.
Okay.
They remain focused on manufacturing and capex as the long-term growth drivers for the economy,
Okay.
while catering to some populist demands, or I would say more than populist, the core demands of the economy at the current juncture, which is to boost consumption, which is to focus on job creation, skilling, and that also is going to be a bedrock of long-term vision
Viksit Bharat 2047
for this government.
Okay. Thank you very much for your valuable time and insights about the post-budget analysis Union Budget 24-25. Thank you very much, madam. We will meet in some other occasions. Thank you.
Sure, thanks a lot. The pleasure is all mine. It's an honor to be here. Thank you.
Thank you, friends and audience. We'll keep you updated. Stay tuned with our all social media channels. Thank you.